This week, three of the most respected institutions in global finance issued warnings about the U.S. economy and stock market that every person with investments needs to understand. Goldman Sachs warned that if oil disruptions from the Iran war persist, the S&P 500 could fall to 5,400. That is a 22% decline from January highs. The technical definition of a bear market. Dimon warned that higher inflation could pull down asset prices, describing the U.S. economy as teetering and listing the Iran war at the top of his concerns. Independent market analysis identified for simultaneous warning signs currently flashing in the stock market, a combination that the last time it appeared preceded a decline that wiped more than $7 trillion off the market. 3 warnings, 1 week, all pointing in the same direction. I am the silent shift. In the next 14 minutes, I am going to break down every one of these warnings in plain language, show you what history says about what comes after them, and give you the 7 specific steps to take right now to protect your money and position it correctly. Stay until step 7. It requires action before Tuesday evening. There is a specific deadline you need to know about. Let me walk through each of the 4 warning signs that are currently flashing simultaneously. Understanding each one individually is less important than understanding what they mean together. Warning sign 1. Consumer confidence below. Every recession starts since 1980. Consumer spending drives approximately 65% of the entire U.S. economy. When consumers feel confident, they spend. When they feel scared, they stop. Consumer confidence just fell below the level that was recorded at the start of every single U.S. recession since the University of Michigan began tracking it in 1980. That is over 40 years of data. Every recession start, without exception, the current reading is below all of them. This matters because when consumers stop spending, companies sell less. When companies sell less, they cut costs. When they cut costs, people lose jobs. When people lose jobs, they spend even less. This is the cycle that defines recessions. And the consumer confidence data suggests we are in the early stages of that cycle beginning. Warning sign 2. The S&P 500 broke below its 200-day moving average. The 200-day moving average is one of the most watched technical signals in professional investing. It represents the average price of the index over the previous 200 trading days. When the current price falls below that average, it signals that the recent trend has shifted from positive to negative. The S&P 500 has dropped more than 8% from its January high, breaking below its critical 200-day moving average for the first time in over a year. Professional fund managers use this signal to adjust portfolio risk. The fact that it just triggered for the first time in over a year is significant. Warning sign 3. The Shiller-Cape ratio at 39.7. The Cape ratio, developed by Nobel Prize-winning economist Robert Shiller, measures stock market valuations adjusted for inflation and averaged over 10 years. It is considered one of the most reliable long-term valuation tools available. The Shiller-Cape ratio hit 39.7 in January 2026, the second highest reading in 150 years of stock market history. The only time it was higher was in 1999 and early 2000, right before the dot-com crash, which wiped 49% off the S&P 500. What this means in plain language: stocks are historically expensive relative to what companies are actually earning. Expensive markets have more downside risk than cheap ones. This does not mean a crash is certain, but it means the margin for error is slim. Warning sign 4. Oil at over $100 per barrel. Before the Iran war began, oil was sitting just above $72 per barrel. Within weeks, it surged to over $112, a spike of more than 50%. The International Energy Agency called it the largest supply disruption in the history of the global oil market. Energy price spikes have preceded every U.S. recession since World War II except COVID. This is not a coincidence. It is the mechanism by which energy costs translate into economic pain across the entire economy. 4 warnings, all present simultaneously, all with historical track records of preceding significant market events. Now let me decode what Goldman Sachs and Dimon actually said, because financial warnings written for institutional investors are often not translated into language that helps ordinary people. Goldman Sachs warning: S&P 500 could fall to 5,400. Goldman Sachs strategists recently warned that persistent disruptions to global oil supplies could drag the S&P 500 down to 5,400 in 2026, a 22% decline from its January peak of 6,979 that would put it in official bear market territory. What Goldman is saying in plain language: if oil stays at over $100 for long enough, it will push inflation higher. Higher inflation means the Federal Reserve cannot cut rates as quickly as the market was hoping. Slower rate cuts mean stocks are worth less today, because their future earnings get discounted at a higher rate. And a 22% decline from peak puts the index below where it was a year ago, eliminating all of 2025's gains. This is Goldman's risk scenario, not their base case. Their base case is still positive. But Goldman publishing a bear market target is significant, because it signals that serious institutional money is running models that include a genuine bear market scenario. They do not publish these warnings to scare retail investors. They publish them to prepare their institutional clients. Jamie Dimon warning: inflation could pull down asset prices. Dimon manages more assets and processes more financial transactions than almost any other person on earth. When he says inflation could pull down asset prices, he is describing the mechanism I explained in the Goldman section. But he is also adding something important. He is naming it as the biggest blind spot right now. The market has been resilient. Stocks are less than 10% off their highs despite everything. And that resilience has made many investors complacent. Dimon is saying, do not confuse the market not crashing yet with the risks not being real. Section 3, the Iran deadline this Tuesday and why it matters. This section is why I asked you to stay until step 7. There's a time-sensitive event this week. The next key market test is Trump's deadline for a deal with Iran on Tuesday evening. Trump expects the Iran situation to wrap up within 2 to 3 weeks. Tuesday is the first major deadline. Here's why this matters so much for markets. The Iran situation is the root cause of the oil shock. The oil shock is the root cause of inflation concern. Inflation concern prevents the Fed from cutting rates. Inability to cut rates is a key driver of the market pressure we are currently experiencing. If Tuesday brings positive signals toward a ceasefire or Strait of Hormuz reopening, oil prices could fall. When oil falls, inflation expectations fall. When inflation expectations fall, the Fed has room to cut rates. When rates come down, stocks go up. A ceasefire signal could trigger one of the sharpest rallies of the year. If Tuesday brings escalation, the opposite. Oil prices surge. Inflation fears spike. Stocks sell off. The Tuesday evening deadline is the most important single market event of the week. Your portfolio decision before Tuesday close is different from Wednesday morning after the news. This is not a recommendation for dramatic moves. It's to ensure your allocation reflects your risk tolerance. Do this before the event, not after it. Section 4. What history says about for simultaneous warning signs. Let me give you the historical context. It's important for calibrating your response. The 4 warning signs: consumer confidence crash, 200-day moving average break, extreme CAPE ratio, and oil shock. These have appeared together before. The historical outcomes are instructive. The combination appeared before the bear market of 2022. The S&P 500 fell 25% over 9 months. But it recovered entirely within 12 months and went on to new all-time highs within 2 years. A version appeared before the dot-com crash of 2000. That was more severe, a 49% decline. But even that recovered. Investors who stayed invested recovered all losses and moved higher. Within 7 years, a version appeared before 2008, the most severe modern recession, a 55% decline. Recovery took 4 years. Investors who kept contributing captured powerful compound growth. The pattern across all these events is identical. The warning signs were real. The declines were real. And the recoveries were every single time. Investors who stayed invested came out ahead. The question is not whether warning signs are real. They are. The question is the right behavioral response. Panic selling is almost always wrong. Patient systematic investing is almost always right. Section 5. The complete 7-step survival guide. Here are the 7 steps. This week, ranked by urgency. Step 1. Act before Tuesday evening. This is the time-sensitive step. Before Tuesday close, ensure your investment allocation reflects your actual risk tolerance and timeline. If the Iran deadline brings positive news, you'll want to be invested to capture the potential rally. If it brings escalation, you'll want to have already adjusted your allocation to match your comfort with volatility. The worst time to make portfolio decisions is in the first 30 minutes after a major news event. Make your decision before the event. Step 2. Build or protect your 6-month emergency fund. Economic disruption increases the probability of layoffs. An emergency fund protects you from selling investments at a loss. If you don't have this, it's your most urgent priority before any new investment. Step 3. Do not add money to speculative positions. Warning signs point toward an environment where low quality, high speculation positions are vulnerable. This is for quality index funds and established, dividend-paying companies, not early-stage bets. Step 4. Increase your monthly investment contributions if emergency savings are covered. A 22% decline in the S&P 500 means every dollar buys 22% more shares. If you're investing for the long term, a bear market is mathematically your best buying environment. Increase contributions systematically. Do not try to time the bottom. Step 5. Check your 401k allocation against your timeline. If you are under 40, remain heavily in stocks. You have time to recover. If you are between 40 and 55, diversify toward bonds or defensive sectors, but remain primarily in stocks. If you are within 10 years of retirement, ensure enough stable assets for your plans. Step 6. Consider adding inflation protection. Goldman and Dimon warnings center on inflation. TIPS are designed to protect purchasing power. TIPS ETFs like SCHP or TIP are accessible. Commodities ETFs also provide hedging. Consider adding a small allocation to one or both if inflation is your primary concern. Step 7. Update your resume and strengthen your professional network this week. Economic uncertainty points toward an elevated layoff environment over the next 6 to 12 months. The best time to strengthen your network and update your resume is before you need to reach out to 3 people. Update your LinkedIn. Make sure your skills are visible. Having options before you need them is the most powerful financial protection available. Goldman Sachs warns of a potential 22% bear market. Jamie Dimon warns of inflation. For simultaneous, market warning signals are flashing, and a key Iran deadline could move markets dramatically. These are serious signals from serious sources. They deserve your attention. They do not deserve your panic. Investors who came out ahead of every market decline were not the ones who predicted the bottom perfectly. They had their emergency fund. They kept contributing systematically. They held quality positions, and they did not make dramatic changes based on fear at the worst possible moment. You have the 7 steps. Some need to happen before Tuesday evening. All are worth doing this week. The warnings are real, the response is clear, and those who act will be in a better position. Subscribe to The Silent Shift for daily finance moves that protect your money and keep you on the right side of history. The shift is quiet, but it is already happening.